Alright, let's go through the FOMC meeting that happened on Wednesday. I'm going to be going through the whole entire summary, what happened in the SEP, which is the summary of economic projections. I'll be going through the nitty-gritty things that actually went through. The Q&A wasn't really that much, but I think the SEP is where it's going to be really, really important. Okay, I'm going to get right into it. I don't want to waste too much of your time. Okay, so the SEP. Basically, for 2023, you can look over here that they are actually saying that the PCE inflation, the previous projection that we actually had was at 3.2 for the end of the year. Right now, it's actually adjusted upwards to 3.3%. But of course, this is actually slight due to the fact that we actually had a little bit of a spike in oil prices. And you can kind of see where their mindset is actually at, because over here you can see it at the core PCE inflation, they actually projected for 3.9% by the end of the year, and now they adjusted it downwards to 3.7% by the end of the year, which basically saying that they are thinking that core inflation will most likely be projecting downwards. So if a trend for the core inflation goes downwards, it also means that if you actually see a increase in the inflation and a decrease in the core inflation, chances are where they actually see a spike in inflation comes in either food or energy. Food prices in general has always been kind of steadily going upwards. We have not seen a deflationary trend, just heavy disinflationary trend on food prices. However, for energy prices, we actually saw prices come down throughout the 2022 to 2023 period after the whole entire Russia-Ukraine situation. In 2023, most of 2023, we actually had prices of oil and energy prices going downwards. However, in the last month alone, we actually got a whopping 0.6% month-over-month inflation that was actually being contributed, almost more than half of it actually coming from energy and oil. So yeah, this is where this actually get a little bit more concerning. Okay, something that you might also want to take a look at is also at the top over here. Change in real GDP, the June projection. Generally, they actually saw that the June projection was about 1% by the end of the year, 1.1 by the next year, 1.8 by 2025. Currently, they actually did have an increase in the GDP projection for 2024, going up from 1.1 all the way to 1.5%. However, you do need to take into consideration that yes, they actually had this projection because we are expecting some form of a level of recession back then, which is why we saw that level of projection. However, for us to actually see a 1.5% GDP increase in the whole entire 2024 is quite concerning, because if we do not really have this so-called recessionary fear that everyone is talking about, then why would we actually only get a 1.5% growth in 2024? Because basically in 2023, we're going to be conquering everything that we were worried about: inflation, unemployment, wage price spiral. Everything is going to be addressed in 2023 as it is. So why in 2024, they're only expecting a 1.5% increase? So there's going to be two possibilities for this. The first possibility is, of course, they actually do think that there are still more headwinds up ahead, which is why they don't want to be so, they want to be a little bit more cautious throughout doing this. The second possibility, which I think is more likely than the former, which is they are worried that people start pumping the market because of this. They are worried that people start to see, oh, okay, 2024, we are expecting 2.5% in 2024. Let's start to, buy into the market immediately, buy in on highs and stuff like that. So I think that they're just kind of worried about inflation just showing up again because of this number. Hence, they just wanted to just show a little bit of an increase in projection, but nothing too crazy. Okay, now, this is where it becomes super duper crazy throughout this whole entire report that I really, really want to talk about. Okay, feast your eyes on this. Federal funds rate. For people who are unaware what the federal funds rate is, effectively is basically what they are talking about being the last, by the end of the year, what would be the interest rates that the Federal Reserve are going to be putting out. Currently, we're at 5.25 all the way to 5.5. Okay, the FOMC actually came out to say that they are going with a pause for this current meeting. However, if you look over here, They are still keeping it at 5.6 but for the end of the year, which means that we technically still have 2 more FOMC meetings, and that means we're still in for 1 more hike. We still have 1 more hike in the cannon, and it's going to be coming out very, very soon, which is why the market kind of tanked a little bit. People were like saying, oh my god, I thought we were done. I thought we were going to be pausing and we're going to be done with this whole entire thing. But no, the Federal Reserve don't think so. And effectively, if later on when we go through the dot plot, I would actually show you, it's not just a few people thinking that they are not done. More than half of the members actually think that they are not done just yet. So yeah, later on when we look through the dot plot, you guys will actually see it. But something that's even more interesting is over here you can see in 2024, the June projection was actually 4.6% interest rate. They were actually expected to cut next year. A lot of people, including myself, we expected the cut to come in about 12 to 15 months later. Chances are we're expecting the cut to come in late September, October-ish for 2024. However, what actually happened here is that for 2024, we're expecting them to not even cut at all. Chances are we might be lucky if they bless us with 1 cut. But ultimately, they're not even projecting for any sort of cuts at all. Also, emphasizing the narrative higher for longer. Because over here, if you actually look at 2025, the June projection, which is the last SCP that we had, it was at 3.4%, and now they are actually projecting it even higher at 3.9% by the end of 2025. So what this actually means is that even by 2025, we're not even anywhere near normal market rates. Because if you end 2025, you're still going to be at 3.9%. Usually we're looking at about 3% or about like 2.8%-ish for like a normal market condition. And even over here, you can see to 2026, they're even looking at 2.9% for the end of 2026. So even at the end of 2026, we're still not seeing interest rate go down that much. It's still not going down that much. Of course, in the longer run, at a even for the longer run, that's true. 2.5%, fair enough. A longer run can mean anything. It can mean 2028. It can mean 2048. Okay? Of course, we want the interest rate down to about 2.5. That's the most optimal range. The most optimal range is actually about 2.3 to 2.6-ish, around that area for normal market conditions. Right now, they're actually projecting it to be about 2.5 in the longer run. But you can tell, in 2026 alone, they're still expecting at 2.9, which effectively means that they're not even done cutting. They're not even done cutting by 2026. So it's going to be a pretty tough time throughout this whole 3 years in the market, but it's going to be an interesting one. Okay, so over here you can also see that I highlighted this, which is basically a range of what's going to be happening according to the Federal Reserve Board member in 2024. They're actually looking at federal funds rate at about 4.6% all the way to 5.4%. Effectively, again, on the high side of cutting, okay, on the high side of cutting, they might be cutting about 1%, which equals to about 4 meetings of cuts, effectively. Otherwise, we can actually be looking at 5.4%, which is the lower side of cutting, which is effectively only cutting it once. So yeah, I think it's going to be quite interesting for us to really see what's going to be happening. I think a lot of the Federal Reserve members right now, the board members, they do have a little bit of a shuffle. Right now, I do think a lot of the members are pretty hawkish. And Jerome Powell himself even came out during the Q&A. He didn't really want to give the market an easy time either. But before I talk more about what Jerome Powell talked about, let's go through this whole entire report so that we can get more into that. Okay, so all this is not that important. I'll just get into this dot plot over here so that you guys can actually see what's going on over here. Okay, so is this zoom out? Okay, is this enough? Okay, wow, you just know for a fact this is 2023, this is 2024, 2025, 2026. Okay, so over here you can see that there's not a lot of consolidation throughout 2024, 2025, 2026. Effectively, a lot of the members are quite, around the spectrum. They're not really sure. But you can see for 2023, more than half of the members actually think that they should stay at 5.6%. Whereas less than half of the members actually think that they should stay at 5.25%, which is effectively saying that they should just pause all the way through. Currently, not even unanimous just yet, but currently people are still thinking that, hey, I think we need just one more rate hike. But in 2024 is where it becomes really, really interesting, because you get one member thinking that, hold on, not only do we not cut, we have to raise rates again. That's why one member is actually putting it at 6.15% for 2024, which is absolutely insane. Which is saying that, this is going against every single street consensus out there right now. One person is saying that instead of cutting rates, instead of just pausing, let's raise rates, which is quite insane. It's quite insane. Okay, so you can see over here, basically, this one guy or one gal is out of the anomaly, putting it at 6.15%. Whereas the rest of them actually basically consolidating around the 5% mark on average. And, I do think that ultimately at about 5.1% or so on average, again, we're kind of looking at maybe one cut next year, and that's about it. We are not sure when the last rate hike is going to be coming in. We're not sure if it's going to be coming in the next meeting or the last meeting of the year. But right now, the market wants it to come even faster, because get it over and done with so that we can start to actually see the full power of this multiple rate hikes that we have actually been going through for the past couple of years. And just right throughout this whole entire thing, we can pause for a year, it doesn't really matter, just pause throughout and we see how it actually goes. That's kind of what the market is actually really wanting from this Federal Reserve at the moment. So over here you can see in 2025, everyone is just having their own dot plots generally. Everyone is just going crazy. One person, I would assume being the same person over here, still think that we're going to be at 5.6%. Like, oh my gosh, it's insane. 5.6% by 2024 is, that's fine. By 2025, 5.6%, this is not just higher for longer, this is higher forever. So I think, this really is scaring the market a little bit. So you can kind of get all this, get all this report on your own. It's going to be on the FOMC website. Just get it on your own, get the PDF version and just look through it yourself. But now what we're going to be going through is what Jerome Powell talked about in the Q&A. It's going to be a pretty short one because he honestly did not really give us that much. However, one person actually asked a very interesting question to Jerome Powell, and he answered it in a way that the market don't really like. So the question basically is asking him, do you think that a soft landing for the United States economy is a base case scenario? And Jerome Powell basically is saying, no, that's not even the base case. Like, we hope for that to happen, but that's not the base case. Do you know how insane that is? That means that right now, the Federal Reserve don't even think that, if everything is just neutral, everything is just static, everything just going as it is, we are not going to get a soft landing. Which is why everyone is basically panicking. People are selling their shares, selling their stock. The market is not doing well. The market is not liking it. The market is not liking it. Of course, Jerome Powell tried to, take back his statements by saying that, but of course, we do hope that we get to a soft landing, and we do see ourselves getting towards the soft landing. It's just that it's not a base case scenario. So it's going to be weird if our bull case scenario is a soft landing, because that means our base case is effectively a recession and our bear case is a depression. Like, it's quite insane how that plane is actually moving in terms of the whole entire Q&A. But I think after that, everyone basically just switched off, and people are just like saying, okay, yeah, Jerome Powell is just gonna stay as hawkish as he always is for the past 5 to 8 meetings or so. So yeah, quite crazy for us to actually see what's going on over there. But effectively, what you have to expect for the next FOMC meeting, honestly, we have one more rate hike to go, which is kind of interesting because in this current meeting, there was only two possibilities. Okay, you either hike your rates or you're gonna pause, and effectively, either one of this decision that were gonna be made, which was already made, but if they were not made, for example, both of them effectively would bring the market down. Having a rate hike would kind of scare the market into thinking, oh my god, another rate hike, sell your stock. Now, having a pause, effectively what you're expecting the market to do is saying, okay, let's buy into the market. But no, that's not happening with the Feds. They're not allowing that. They're like saying, nah, we're not getting a soft landing as a base case. We have one more rate hike. We have higher for longer rates. We are gonna have no cuts for the next year. There's so many rubbish coming in that people are just saying, sell. I'm gonna get out all of my shares. I don't want to be holding onto any company shares. And something also quite interesting is that if you actually bought into the whole Nvidia craze when it was at $517, FYI is currently at $410, down about 20%. And that's what I've been telling a lot of people as well. Don't rush into Nvidia after that earnings call. I think Nvidia is a good company, don't get me wrong. A lot of good companies are out there, but we're expecting a big discount on a lot of companies. Good and bad. A lot of companies are going to be going on discount pretty soon. We don't know when. So of course, if you do want to invest in the market, try to park some cash aside. Maybe, just cash in on a few good deals on the way down, and then maybe cash in on a few good deals on the way up as well. That's kind of how investing is. But anyway, that's all I have for this FOMC summary. Hope you guys enjoy this sort of content, and I'll see you guys in the next one. Peace out. Bye.